Thank you for joining me today for our discussion of ESG investing. As you may expect, I have a brief legal disclaimer to share with you. This presentation is for information purposes only. We're not giving investment advice for specific situations, nor are we inviting or inducing any investment activity or selling securities. We believe the sources of our data to be reliable. Our analysis can change over time and may not be current if viewing a replay of this presentation. Be sure to engage proper investment advice for your situation. Today's presentation is a brief look at how to make values-based investment programs better. This field is rapidly growing, but skeptics remain, and there are some legal challenges to fully realizing the goals of those whose efforts have driven this movement. While there are many forms of values-based investing, you'll most commonly hear them described using the terms shown on this screen, with each having a slightly different meaning. In our context today, we are applying these terms to companies that raise capital in the public markets. ESG, the most commonly heard term, refers to analysis of the environmental impact, social responsibility, and general governance of organizations. Socially responsible investing is quite similar, and many will recall the work of Peter Kinder, Steve Leidenberg, and Amy Dominy of KLD, who are among the pioneers of socially responsible investing. In essence, SRI looks to add a morals component to investment decisions, while at the same time seeking better performance. Impact investing usually has a specific social purpose or goal to achieve. The divestiture from South African investments in the 1980s falls into this category, but could also be described as a member of the SRI category. Work to implement the UN Sustainable Development Goals falls into the impact investing category as well. Ethical investing shares traits with all of the above, but tends to be associated with specific religious beliefs and may exclude companies from investment portfolios based on a single line of business in which they operate. The general goals of these movements are mostly aligned and are about seeking better ways to put investment capital to use, with the term better meaning looking beyond investment returns alone and towards some social good. While not specifically correct, for brevity and clarity, we're going to group all of these under the moniker of ESG investing during our discussion today. As with any economic problem, we have a number of interested parties to consider when looking for success in ESG investing. The legal obligations of the first group are fairly clear. The duty of care is a fiduciary duty to manage investments or govern companies well. Compliance with laws and regulations is usually a bare minimum expectation, but it's included here because of the impact that regulators can have on an organization's ability to succeed. And finally, meeting return objectives to fund liabilities or to fund budgets is likewise a basic expectation. But the economic question doesn't end there. Businesses have complex social networks, people and other organizations whose success is interwoven with the success of that firm or who may be impacted by its actions. The legal obligations that an organization has to the others may be less clear, and therefore less likely to be front and center in the discussions and considerations of the key players who have the fiduciary duties mentioned in the previous slide. To solve this economic problem, or more accurately to maximize its value, we're looking to solve three equations simultaneously. First, to do good beyond making money. Second, to fulfill our fiduciary obligations. And third, to positively impact those with whom we have some relationship. Solving three equations simultaneously, as anyone who has studied math even in high school knows, can be very difficult. So let's begin with the first equation, what we want from our ethical investing, SRI or impact investing, again consolidated here under the moniker of ESG investing. While not complete, we do have several data providers that help us to evaluate publicly traded companies. These include MSCI, ISS, Sustainalytics, Thomson Reuters, True Value Labs, and many more, including my company. This isn't a perfect way to solve this equation, but it's pretty good, and it's where most exclusionary approaches to ESG investing begin. By exclusionary, we mean using data in ways to keep companies out of portfolios, rather than inclusionary, which is a process that looks for reasons to add a company to a portfolio. We can use the data from these vendors to identify companies in our portfolio that are failing relative to others to address our concerns and remove them from receipt of our investment capital in theory, making it more difficult/more expensive for them to raise capital. It's a punishment and reward approach to driving our beliefs and values to their bottom line. There are many challenges to this approach, including different opinions among these providers and the fact that not everyone has the same set of values. Again, it's a pretty good starting place to answer the question about whether our investment portfolios are adhering to our own values. Now let's look at the second equation that needs to be solved. These return requirements are hard numbers. There's not a lot of room for feelings here, and those responsible for meeting these hurdles face very clear legal duties, specific for portfolio managers, trustees, or boards. Since all aspects of capital raising are competitive, there's not a lot of wiggle room. If you tell someone from this group of fiduciaries to do something because it's just, right, or ethical, but it hurts returns, you've got a hard sell in front of you, and you may not have the law on your side. For a moment, we'll hold off on the third equation and really focus on solving the first two. When I first started talking with prospective clients about 10 years ago, most had never heard of the idea of using governance as an investment criteria. Our meaning of governance is far more all-encompassing than the G in ESG. What we mean by governance is all that affects an organization's ability to achieve its goals. So there's a lot of overlap, but the concept behind our approach was still a relatively novel idea back in 2009. At this same time, ESG was beginning to gain some traction, but it was still very much of a fringe concept. With anything new like governance-themed or ESG investing, especially in an environment like we had after the financial crisis, we had to address a long list of reasons given why not to change what is standard practice. Especially then, people could lose jobs for experimenting with new things if they didn't work out. Among those concerns was the idea that adding anything new to the investment process would be a cost. The understanding of how better governance affects all aspects of the value equation was not well understood. ESG seemed even more burdensome and was thus expected to be returns destroying. While some of those cost fears have moderated, we still face concerns about the quality and integrity of the data used to assess ESG practices. If you look at the same company via the lens of different analysts, you in many cases will find divergent opinions. Part of this has to do with how elements of ESG are weighted by each vendor, and part with how they are interpreted. According to whose values and across what industries do we compare? Academic literature and backtesting have shown both positive and negative outcomes of implementing ESG programs, and there's some evidence that the alpha found early on was explainable by other factors, like market capitalization and momentum. In some cases, the alpha from early academic papers seemed to disappear by the late first decade of this century. If alpha is disappearing, it might be because, quote, doing good is prioritized over maximizing returns. Or it could be that the markets are not accurately capturing the often deferred risks of environmental, social, and governance shortcomings. And as Friedman and others put forward in theory, the markets will arbitrage away any advantage from ESG data. Further, any restrictions placed on a set of possibilities on the number of stocks that might be possibly included in a portfolio will almost always negatively impact optimization programs. In other words, exclusionary screens always lead to suboptimal outcomes. To solve our first two equations simultaneously, we need to address these concerns in a positive fashion. We're going to try and get some hard data together without bias or need to defend an academic worldview. Today, we'll go back over the past 3 years and compare some results from hypothetical investment portfolios. Let's begin with the year 2015 to see if the fears about the cost of ESG investing play out in reality. We're going to use the ESG data from 2 vendors and select the very best companies according to their ratings. This is generally the top 20%, which in the U.S. gives us about 250 companies from one vendor, and at this time about 150 from another. And we'll see how that hypothetical portfolio of those holdings did. As the first chart shows, this was a year of little gain in stock prices overall, along with a fair amount of volatility. The Russell 3000, including dividends, barely returned a positive figure. Hence, when adjusting for the risk-free rate and volatility, garnered a negative Sharpe ratio. No one would be pleased by this performance. So how about the performance of ESG strategies? Using the data from the first vendor, we constructed a portfolio of their best companies from an ESG standpoint. The result was a lower return, barely, higher volatility, slightly, and a worse Sharpe ratio. Not a good start to our analysis. Using the data from the second vendor, we get a different set of stocks and a worse outcome. These outcomes are quite worrisome. Anyone who convinced their company to pursue ESG in 2015, a time when it was again okay to try new things, would find the results difficult to justify a continuation of the program. Assets might flee, budgets might not be met, liabilities might be further underfunded. Someone might get fired. When looking at what some of the possible explanations are for this disappointing of ESG investing, we can consider a long list. Was it just bad luck? Was 2015 the wrong year to start? Was there not enough volatility? You can think of volatility in the markets much like a strong wind blowing the dead sticks and the dead branches off of a tree. In a way, it's cleansing, and the companies that are weak, the ones that perhaps are exposed to more ESG risks, can be shown to be vulnerable. There's no trend in the market, so maybe there was nothing that was encouraging people to take particular positions. Or maybe there was even too much volatility and people were afraid to try new things. We also have to consider that the ESG data might have been bad. Maybe it didn't reveal the story as we'd hoped it had. Or maybe the people who were worried about the costs of ESG were right, so that the 200 basis point underperformance by the second vendor is just a reflection of that loss from being selective, from excluding certain companies. And maybe ESG investing just doesn't work. Or maybe there's something to the point made by ESG investing's distractors. The markets are pretty smart, although they're far from perfect. Remember, these ESG data screens try to solve the first equation in our economic problem. We can, for the most part, feel good if our investment portfolio only contains the top ESG companies. But the group about which the second equation is concerned doesn't have the legal duty to feel good about anything other than meeting their corporate objectives. So we need to be thinking more and more about broadening our definition and process of ESG investing if we want this to work out in a better way. So let's try to improve our ESG stars portfolios a bit. Let's try to build on this good foundation by thinking like a portfolio manager is bound to think. Is there more beyond ESG? Sustainability is a term that's often associated with ESG investing. At the Governance Fund, we've broadened ESG by thinking about sustainability in a new way so that it includes portfolio impacting risks. In other words, how sustainable is a company's outperformance in terms of stock price relative to risk? Or how likely is it that a company will continue to underperform or negatively surprise us? What's the downside risk? All of these questions are driven by ESG factors and more. By answering questions about key factors like ESG, financial governance, perceived risk, prospective risk, dividend sustainability, economic profit, momentum, probability of default, predictability, trends in quality, governance, value, and risk, plus many more, we're able to calculate sustainable value grades for over 1,500 U.S. companies in the areas of ESG, plus financial governance and quality. Now, adopting the mindset of a portfolio manager with legal duties, we expand on ESG using something we call a market-implied governance metric. In addition to the factors previously mentioned, grades for price risk and relative valuation are then able to be calculated and reported. Sustainable value grades range from A+ to F-, and no one wants an F-. And guess what? When you do this, you find some cracks in the veneer of the top ESG companies as identified by the data providers. Of those top ESG companies, 1 in 8 earns an F rating for financial governance. 1 in 10 have an F rating for quality. 1 in 8 have an F rating for relative risk, and nearly 1 in 5 of these ESGs that receive A's from the vendors receive an F for valuation. Using these sustainable value grades, we can create a different list of ESG star companies, or using our meaning of G, governance star companies. And during 2015, that select group enjoyed positive returns and a positive Sharpe ratio, even though it was a slightly more volatile portfolio. Better ESG portfolios are better portfolios when you consider all of these additional factors that portfolio managers must consider. We get better returns on risk, both of which mean we have better met our fiduciary obligations, solving for both equations 1 and 2 simultaneously. If our enterprising ESG portfolio manager had done this in 2015, they'd not only still be employed, but they might have more AUM for 2016, and that turns out would have been a very good thing. In 2016, the vendor ESG data portfolios outperformed substantially. And when we screen out the ones that fail the portfolio manager familiar criteria via our sustainable value grades for financial governance, quality, risk, and valuation, they get even better. We call these shaped versions of those portfolios derived using the vendor data. Portfolio shaping is a process we discuss in another video available on our website or on YouTube. But if you see here, the vendors, vendor A in this case, outperformed the Russell 3000 quite substantially when you just took the best of their companies. Slightly more than 500 basis points in 2016 for vendor A. The performance by vendor B, almost 600 basis points better. But in both cases, the shaped portfolios of the data provided by those two vendors outperformed just the raw amount, and the Sharpe ratios were higher across the board. In 2017, the vendor ESG start portfolios outperform again, and the shaped ESG portfolios do even better. In this case, and I think everyone remembers that year, the Sharpe ratios for stocks overall were ridiculous. We won't see much like this ever again. But we're still able to improve on the Sharpe ratios using the vendor data and then shaping that vendor data by including these portfolio manager-specific evaluations. So what does a sustainable value grade look like? This is part of one for Deere & Company. We use this one as an example for a few reasons. First, we use Deere & Company as an example in our portfolio shaping video, so it's here for consistency and comparison. Second, it's a great example of where ESG data overall puts Deere & Company into the good group for a values-based portfolio, but it receives F- and an F+ in all the other sustainable value grades. You wouldn't know that by just using the typical ESG metrics. Third, in our internal portfolio, we transferred capital from Deere & Company to better places. Capital transfer means we actually shorted an A- rated ESG company and invested that capital in a better place. That may seem incongruous unless you widen your definition of responsible governance like we have. Since we initiated that back at the end of February, Deere & Company stock has underperformed the broad market by more than 15% through the 1st of May. What are some of the risk factors that come out via the sustainable value grades approach? Well, if you look at the screen, anything that's got a dark red color to it. Some of the biggest concerns are around accounting quality, the probabilities of manipulation, organizational complacency, and financial strength. Under relative risk, Deere is highlighted as having among the top prospective risks of all companies that we look at, and as a result, we get signals that this isn't a good place for your risk capital. Now, not everyone can or wants to include short positions in their portfolios, but let's do something radical as a way to further demonstrate the point that we must solve for both our values-based desires and the fiduciary obligations of our asset managers. Let's actually short the top ESG companies that fail our other criteria and reallocate that capital to the ones that fulfill both our ESG requirements and the more financially focused requirements around financial governance, quality, risk, and valuations. Things get even better. The data you see here reflects the entire period of 2015, 2016, and 2017. The Russell 3000 enjoyed annualized returns of about 10.5% on modest volatility, so the Sharpe ratios realized were higher than historical norms. The data using vendor A's top ESG rated companies improved on that by almost 300 basis points. Data B or data vendor B improved by about 70 basis points and a higher Sharpe ratio. So those are both material improvements. But now when you start to include shorting, even companies that have received high ESG ratings from these vendors, the improvement is another 200 basis points on vendor A and almost 300 basis points on vendor B. And if you don't want to short, but you just use the top-rated companies with the sustainable value grades, we still get an outperformance and the best Sharpe ratio of all the methods. Now, if you took the approach to short bad ESG companies, the results can get even better than this. To succeed in achieving the goals of doing more good with investing, we can begin with ESG, and that's a really good starting point. But we also want to have companies in our portfolios that are good stewards of their finances, good financial governance, as that's a reflection of a positive culture. We want companies that have engaged with their customers and innovated such that the quality of the financial results they produce is high. That's a reflection of good corporate culture. And finally, we want to make sure that we have companies that the market hasn't already figured out, or the return on invested capital, our risk capital, won't be as good as it could be. If we have a portfolio that has high quality ESG, high quality financial governance, high quality of financial outcomes, and a favorable risk profile, and the market hasn't yet overpriced that, it's a pretty hard portfolio to argue with, and is one that we can present any of our trustees, customers, regulators, or others interested in what we do as an exemplary portfolio. It satisfies both our values-based desires and fiduciary expectations. The third equation we're trying to solve simultaneously has to do with how we treat others that are part of our company's social network. That topic is covered by my book called Governance Reimagined and is more in depth than we can cover here. But once we have the portfolio managers buying into the benefits of ESG investing and the boards of portfolio companies in agreement, the third equation becomes much easier to solve. The outcomes? Well, we provide a more reliable platform for long-term employment. We provide more surety for retirees whose pensions may depend on that company's success. We bring about a better and broader understanding of the impact that environmental and social factors have on the value of our companies. And we stimulate better engagement of those stakeholders in the long-term planning of companies. If we've got all of this, we've succeeded in doing good. As a reminder, we're looking to solve three equations simultaneously that will make everyone better off. We do this by incorporating ESG factors, and we've got lots of vendors who can provide us with that data. We do this by also including key factors around financial governance, quality, relative risk, and relative valuations. A lot of this you can do on your own, but it's important that it's incorporated so that we're reaching a full satisfaction of all of these criteria. Boards and portfolio managers will be fulfilling their duty of care and other fiduciary duties better by doing this, and the result will be a benefit for all. So we're not selling any investment funds. Our services instead provide forward-looking risk advisory for institutional clients. As noted with the vendor ESG star portfolios, there are usually hidden risks in companies that we uncover. We can almost surely make you better at what you do by finding the risks you may not know exist in your portfolio companies. We can also work with the boards of your portfolio companies to help them understand the value of incorporating ESG concepts in their strategic planning and can find the right people to lead this effort. The Governance Fund's a private initiative to foster the better governance, understanding, and use of risk in the pursuit of value creation. I'm happy to help you if you'd like to contact me to run a screen of your current portfolio, to talk about our sustainable value grades process and reports, discuss your own work and how you'd like to approach this, or to discuss engagement of your portfolio companies. I appreciate your joining me today. I hope you found this overview to be very helpful. If you have any questions, again, please don't hesitate to contact me at the email address on the screen now or by calling me at the number you see. Thank you again.